Hello everyone, welcome back to a new video here on Activities. Today we're going to look at Microsoft. Yesterday we looked at Meta platforms. If you guys haven't seen that video yet, I would be sure to make sure to check it out because it's quite an insightful video, if anything. So today we're going to look at Microsoft. Of course, one of the biggest companies in the US. It kind of trades spots with Apple and sometimes with Nvidia and whatever. Definitely a very like a mega cap, you could almost say. And today we're going to look at their Q2 2025 earnings, or Q4 2024. Just kind of how you look at the business cycle, but they've decided to do it this way. Anyhow, the latest quarterly earnings, okay? The schedule for today is going to be some qualitative business characteristics, a very short section. Then we're going to look at the last earnings report, some quantitative characteristics, and then we're going to do a valuation, and we're going to look at some price ratios. So what sets Microsoft apart from a qualitative perspective? Well, it's a strong business-to-business software player, right? It sells software like Excel, Word, operating systems like Windows, of course, which is their probably also the thing they're most famous for towards the consumer, together with Word. It sells cloud solutions to businesses, so it does all sorts of business to business. It does sell business to consumer a little bit, but its main bread and butter comes from business to business. A lot of its revenue comes from subscriptions, which is a very good thing. Subscriptions are reliable. They're relatively easy to predict, at least a lot easier than, well, non-subscription based revenue. So that's also a very good thing about Microsoft. Also, the nature of its products is of course a good thing. After all, if a recession does come, Microsoft's revenue is least likely to get cut. After all, business still needs operating software. A business still needs Word or Excel to function. It still needs its cloud, which has all of its data. Compare that to, for example, Alphabet or to Meta, and they have a large advertising income. Well, that's a lot less recession-proof because advertising budgets tend to be the first to get cut during a recession. The same goes, for example, for Amazon, has a lot of consumers, right? Luxury products. So I think, in my opinion, Microsoft, out of the mega caps, is one of the most recession-proof businesses, which is definitely another tailwind for the business. Then also it has a strong monopoly in large markets, right? Which is once again a very good thing. And there's a high growth in cloud and AI. Some of the newest businesses, right? So key parts of the last earnings report. Well, first of all, revenue was up 12% to 69.6 billion. Operating income was 31.7 billion, increased 17%. Net income 24.1 billion, and diluted income earnings per share was $3.23, all up 10%. If you look at all of this, there's only one part that's really interesting about all of this data, and that's this little part here. And that's their Azure growth, standing at 31%, which is immense growth. It's even up from last year where it was 30%. So it's just immense growth. And this is also the main reason why I think that revenue growth and net income growth for Microsoft is might even pick up in the near future, because, or well, in the future anyhow, because I think that as more as Azure grows, the larger part of the business that it becomes, and the larger part of the business it becomes, and as long as it remains is high growth, then it's going to make up a larger portion of revenue, a larger portion of net income, and thus net income and a larger portion of revenue is going to grow quicker. So there is a possibility that revenue and net income will actually pick up and grow even more in the near future. So there's some things you can consider when valuing Microsoft, and there are very interesting parts about this business. So overall, the earnings report was actually very strong. Okay, the only thing they missed on was guidance revenue of I think it was like $100 million lower, or $1 billion, something like that. Really a minor part, which in my opinion doesn't really justify the downturn of almost like 6%. But anyhow, if we're going to look at the guidance, because of course it's a major pretty important part, right? Productivity in Q3 2025 compared to Q3 2024, so 1 year ago, expected to increase 9%, cloud 17.7%, personal is expected to stay somewhat flat, COGS expected to be 17.5% up, OPEX to be 4.3% up, other expenses, well, negligible difference anyhow, so I'm not going to calculate that. Tax rates to stay pretty much at 18%. Net income about 23.78 billion, or up 8.4%. EPS is likely going to be up a little bit more, of course, because they're going to buy back some more shares and whatnot. Overall looks pretty okay. Now, of course, 8.4% is lower than the 10% they announced this quarter, so there are some things to look at. Mind you, these are all midpoints, so this is guidance on the midpoint. Now, there is a possibility that they get a little bit higher, right? That they're a little bit more conservative with guidance, which Microsoft is quite infamous for. So there is a possibility that it is a little bit more than this, but we'll have to see. We'll have to see what the real numbers are going to be. But overall, the guidance looks pretty okay. I must say though, it's not overwhelming. It's not very great. It's not very good. Though it looks okay. It's acceptable, but it's not very good. It's not a big change or anything. I'm going to look at the ratios. We see the current ratio is standing at 1.35. Last year was 1.24. So current ratio has gone up a little bit. I think overall current ratio for these tech stocks, because mind you, current ratio is somewhat equal to quick ratio because I don't have an inventory. But overall, I think 1.35 is a perfect current ratio. I wouldn't want it any higher, wouldn't want it any lower. At least not significantly. I think current ratio between 1.2 and 1.4 to 1.5 is very good for a tech stock. I think it was Alphabet who had a current ratio of 2, which is, in my opinion, way too high. That's just way too much. At that point, as a business, you should seriously reconsider your stewardship and perhaps your returns on shareholder value. You should maybe consider investing more in the business, thus shifting current assets to, well, non-current assets. So there are some things that you as a business should reconsider if your current ratio is just way too high. And I think 2 is way too high for Alphabet. But 1.35 is just pretty much perfect. Very happy with that. Gross margin, operating margin, profit margin stands at pretty high numbers. Pretty much what we're used to of Microsoft. Now, these margins didn't increase or decrease year over year, so overall pretty well. Stewardship returned 9.7 billion in dividends and share buybacks this quarter, up 6.6 year over year. Then we're going to the valuation part. The valuation we're calculating with a WACC of 9.14%. They have an amount of debt of 235 billion. Cost of debt is about 5%. Amount of equity, well, this is the market cap. Cost of equity 9.46%, calculated with a CAPM model, okay, with a BAT of 0.9, market return of 10%, and risk-free rate of 4.57%. So we get a total WACC of 9.14%. Plug it into the valuation with our cash flows. This is for year 1. That's next year, basically. We're expecting annual operational cash flow to be about 125 billion for next year and growing at, I don't know what the growth rate is, actually. That's pretty bad. Let me quickly look at what the growth rate is standing at. Oh, is that not over there? It's supposed to be. Anyhow, revenue expected to be 12.3% growing year over year. And we're actually calculating with a pretty conservative OPEX growth, which is 8.3% for the SG&A and 12.5% for R&D. Taxes at 19%, which is also quite an conservative estimate. So overall, it's not looking too crazy. Depreciation growing at 20% year over year. Our expectations for the next 10 years. Then eventually get to annual operational cash flows of nearly 500 billion in year 10, which is just crazy high. Is it impossible? Absolutely not. It's definitely a possibility after all. It's not. It's not a crazy estimate. It's just pretty conservative. Annual capital expenditures expect to be about 60 billion this fiscal year. Okay. So that's I know Satya Nadella said something about 80 billion. But the CFO of Microsoft reiterated in this earnings report that they're going to spend 60 billion. So I don't know what Satya Nadella was talking about with 80 billion, but and that capex in the following years is going to grow, but not as much as it did in 2025. So I'm just plugged in 5%. Annual free cash flow rolls out. Discounting factor, of course. Total discounted free cash flow for the next 10 years is about $1 trillion. If we plug the perpetuity growth model, get the 11th year free cash flow, we get a discounting factor and a company value of $2.5 trillion. Now, of course, these two values you need to add up. I don't know if it's gonna. Yeah. Okay. We got some technical difficulties here. We add these divided by the number of shares, and we get a fair value share price of $471.5, which is about 10% higher, right? It's about it would indicate a 10% undervaluation for Microsoft Corporation. Now we're not going to apply my margin of safety because I think for a business like Microsoft it just makes no sense to do. But anyhow, if you would want one, then you could say you have a margin of safety of 10%. I would just say it's an undervaluation, but whatever. Price ratios, well, we see that PE has been increasing year over year. Mind you, these ratios do not include the last fiscal quarter. Macro trends apparently isn't that fast with these things. Too bad. Anyhow, price ratio is going up. Price to sales ratio has gone up. You can see, however, that in the last 4 years, these ratios haven't really increased, right? You can see since 2020, these ratios tends to kind of plateau a little bit. We see price to sales increases a little bit, but overall stays pretty stagnant. Price to free cash flow ratio has just been increasing year over pretty much forever. What does this tell us? And that's the major part that's important. It means that we have seen in the last 15 years a lot of multiple expansion, right? We've seen price to free cash flow ratio gone up pretty much 4x. You could even almost say 5x. PE ratio gone up pretty much tripled. Price to sales pretty much doubled. Also tripled, actually, I should say. So that means that a lot of growth that we've seen in the last 15 years has been multiple expansion. And the concern with that is, for obvious reasons, that multiples don't tend to increase infinitely, right? It's not going to increase to 100. You see that sometimes, but I think for Microsoft that's very doubtful, unless they come out with some product that shows enormous growth potential. So overall, I don't know, but once again, if you ask me, is Microsoft right now a more solid business than 15 years ago? I would also say, yeah, for sure it is, right? So you have to look at these ratios and kind of place yourself in the minds of a Microsoft investor 15 years ago. And at that time, Microsoft was valued at about $200 billion, mind you, $300 billion. So that also means, by the way, you had a 10x in the last 15 years if you had invested in Microsoft, which is just a crazy return. I don't quickly see that happening anytime again, but once again, I mean, you never know. However, if you're asking me in 10 years, which business do you think is going to be a $10 trillion company? It's either going to be Microsoft in my book, or it's going to be Amazon. Also a very good bet. You could perhaps also put NVIDIA in there if chips actually grow a whole lot in the next 10 years, but we never know. So, but I think Microsoft is a pretty good bet. It's a stable company, at big monopolies, strong growth. And if Azure growth just continues, and Azure continues to become a larger and larger part of the business, I could also see revenue and net income growth picking up, So even the 12.3% revenue growth that we've calculated our cash flows with right now might even pick up a whole lot more in the future, right? Maybe we're talking about 20% revenue growth in 5 years or so. We never know. So those are some possibilities. Now, I'm not saying that's a guarantee. Once again, I'm not a financial advisor or anything, but it's a possibility, and it's something to keep in mind. And it's definitely a thing that makes this company a whole lot more attractive. So I would say overall, the company of Microsoft right now looks pretty decent. It's definitely not a bad bet to invest in Microsoft. Now, of course, I would recommend any of you to do your own due diligence, but one thing I can tell you is that I did buy some Microsoft after this earnings report because, in my opinion, it's just crazy undervalued right now. But then again, of course, do your own due diligence. I'm gonna finish the video here because I don't want to make it too long. Do your own due diligence, do your own research. Remember that this video is, of course, no investment advice, right? I have to say that because I don't want to get into any trouble. Thank you guys very much for watching, and I'll see you guys in the next video. Goodbye.